does the broader macro, is the broader macro for India supportive, or could it turn disruptive? I mean, I know crude is kind of variable and it's behaving well right now, but just thinking out loud, is the broader macro supportive or not so?
Meaning the external macro? No, I think the domestic drivers of growth are mostly, or other the drivers of growth are mostly domestic, and that's something that should hold up, right? So like construction activity, so dwelling construction, and we've been talking about this since November last year, that look, there is a multi-year cycle in dwelling construction which is imminent. It is now starting to play out. My apprehension is that prices of real estate are going up a bit too fast, but maybe it is a necessary condition for developers to start accelerating construction, because the upside for them if they deliver more houses is that much more. But still, that activity is on. The state government spending, there's evidence now that that's coming online. The government cash balance with RBI has fallen quite sharply, so from like 5.6 lakh crores to less than 2 lakh crores. This is despite strong tax collection. So if the tax collections are strong, they're borrowing more or less, they're slightly less than expected, but and their cash balances are falling, which means they're spending. That's arithmetic. And all of this means that domestic drivers of growth are very much intact. Fiscally, the higher tax to GDP gives a lot of comfort to people. The inflation indicators, and of course the recent downward the inflation coming in lower than expected was mostly because of vegetables. They tend to be very volatile, but the good thing is that there is a supply response showing up in all major vegetables, even in eggs and lots of other things. So the inflationary pressures are also easing, and that brings us to the external, right? So when you're thinking about macro factors, I think the slowdown in exports is something we should be very worried about. Just to give you perspective, if you were earlier modeling $100 per barrel oil, and now you have $80 per barrel oil, there is a $20 saving, which into 1.5, because we know we consume about 1.5 billion barrels a year. So that's like a $30 billion saving. But if your exports, and remember that oil is falling right now, despite supply still drifting down, which means that it is a serious demand problem.
Right.
And so if your exports fall by 10%, you're talking about a $40 billion slip up. If your dollar loans, so every year we tend to get $15-20 billion of external commercial borrowings. Now that is and that is a net basis, right? But on a gross basis, there is a lot more that gets rolled over, meaning this is a repayment and then you take a fresh loan against that, to pay for that. If that stops, that plus 20 could become minus 20. So that's like a $40 billion swing again on the balance of payments. So the reason to be worried about balance of payments has shifted from high energy prices to weak exports, as well as a potential risk of capital outflows, especially on the debt account. So that's something that I worry about. But on the other domestic drivers, I think numbers are very strong.